And now to some investment analysis. I'm joined by fund manager Roger Montgomery, who's been taking a critical look at the rise of equity index funds and ETFs, or electronically traded funds. Now, Roger, first of all, what are these?
Well, essentially they're a basket of stocks that mimic the index. And they're, in the case of ETFs, exchange-traded funds, they're simply a single stock on the stock exchange, and by buying one of those stocks, you immediately have exposure on the same basis as the index to all of the stocks in the index.
Now, they've become very popular. Why?
Incredibly popular. Well, because the marketing machine of index fund managers is obviously very, very good. And the marketing spin, what they say to investors is, we beat the majority of fund managers. Well, in Australia, that's just not true. In Australia, particularly in the small cap space, the majority of fund managers beat their respective index. So that part's not true. What I don't like about index investing is that it's just dumb investing. It's the mindless buying of a basket of stocks, and an ever-increasing basket of stocks as index investing becomes more popular, with no understanding or care for the underlying fundamentals.
But right at the moment, where the equity market has been going up,
yes,
I mean, everybody's been doing well, including...
Well, rising tide lifts all boats.
Well, exactly. And so even over sort of 3 years, these index funds have been doing quite well.
Yes, over 3 years that's true. Over 7 years it's not true. Over 7 years, or 6 or 7 years, the ASX 200 remains exactly where it was, yes, and it hasn't grown at all. There is an inordinate number of Australian businesses, and we've talked about it on this program many, many times, that are generating lousy returns on equity, and over long periods of time the share price will follow that. But what's going to happen is, as index funds become more popular and there's an increasing amount of blind and dumb buying of a larger basket of stocks, you'll see divergence between the fundamental value of companies and their price. That will result in more volatility, that will result in lower returns, and it will be exactly the opposite of what many index investors intended to receive.
So why did Warren Buffett advise us to go and go?
Well, he advised his wife. He thought he would die first, and he advised his wife, Susie, who's now passed away, to invest in index funds. He said this, though, and people don't remember this. He said, index investing suits the know-nothing investor. If you're not interested in analysing businesses and you're not interested in only building a portfolio of outstanding companies, well, index investing makes a lot of sense. But there are a lot of very, very good professionals in Australia who are trouncing the index over many, many years. So it's not as appealing, blind and dumb index investing, as it might be in the United States.
So if you were just a dumb index investor, as you describe it, then would you, even though you wouldn't do better than value investing potentially, but would you do better over time than, say, inflation?
But by definition, you should do better than inflation if you're invested in companies that have pricing power. But unfortunately, in the index, there are a lot of big businesses that don't have that pricing power, and they have a very heavy weight in the index. As a result, the index won't perform very, very well. You're better off in a basket of outstanding businesses.
Okay. So is there any time when you would recommend investing in these things?
Well, I think the right answer might be when the market's on its knees and there's blood in the streets, and we'll be talking about that in due course, yeah. Just as we're talking about it being in a bubble. Exactly, yeah. Not too soon. But at the same time, you're better off buying businesses that are doing extraordinarily well and that will do extraordinarily well. The index, by definition, is always invested in mediocre businesses as well as good businesses, and that's what's going to hobble its performance.
And in the meantime, you'd buy into Berkshire Hathaway in a way, because
look, if you wanted to beat the index,
yes,
you would have bought into Berkshire Hathaway, exactly.
Because you're using his expertise.
Correct.
Yes.
You're using a fund manager.
Right, very good. Roger Montgomery, thank you very much for joining us.
A pleasure, Ticky.